Stocks losing a bit of steam heading into the close on Wall Street. Fed Chair Jerome Powell testifying on Capitol Hill, saying the central bank in no hurry to cut rates. But now investors shifting their focus to inflation data ahead of the open. And our next guest says it's all about core CPI. Joining us now is Kristina Hooper, Invesco Chief Global Market Strategist. Kristina, good to see you here on set.
Great to see you.
So I actually do want to get your take quickly on the news of the day, which was Fed Chair Jerome Powell. He was talking to lawmakers, and the takeaway there, the message, it was really simple, Kristina. It was, listen, we are in no rush to adjust interest rates. Economy's doing well, right? We'd like to see a bit more progress on inflation. What did you take from that testimony there? What did you make of it?
I think it was very much a repeat of what we heard in the last FOMC press conference. It was all about patience. We're going to be very careful about our next move. And quite frankly, we're happy with where we are.
And do you think that that happiness is justified? You know, we're going to get a CPI print tomorrow morning. Do you think that we are going to continue to see this disinflationary trend?
I think we are going to continue to see it, but it could be imperfect and a little ugly. I don't think it's going to be, a natural improvement in disinflation every single month. And so we could get some surprises, some ugly components, and we just have to watch for that. I think what the Fed is going to do is take some time and wait to assess trends. I don't think it's going to make any moves. I think the earliest it would cut again is probably the end of the second quarter.
Yeah, because I'm sure, Kristina, a lot of viewers are probably watching right now. They're saying if inflation's still above target and the labor market is showing you signs that it's appears to have stabilized, why would the Fed cut?
Well, because as Jay Powell admitted at the FOMC press conference and admits at multiple occasions, is that monetary policy is restrictive. If we look at where we are today in terms of inflation versus where the Fed funds rate, and if we were to actually add in quantitative tightening, other monetary policy tools, what we get is an even more restrictive monetary policy. So as long as you're confident that disinflation is going to continue, then it would actually be a reason to continue to cut. But given where we are, I think the Fed is being thoughtful, careful, prudent, and saying, let's assess the data, let's hit the pause button.
Right. So what does all of this mean for U.S. stocks, right? Because I know U.S. stocks are not actually your preferred trade right now, or in terms of your preferred weightings and allocations. Why not?
Well, it means that U.S. stocks are going to have to stand on their earnings. And earnings season has been quite good, and I think the outlook is quite good, but U.S. stocks are expensive when we look at the overall index. Now, there are many parts of the stock market that are far more attractively valued, but in general, what we have is stocks that are seeing earnings catch up to where they are in terms of prices. And so there are opportunities outside the U.S. Now, the economies don't look nearly as good. As we've heard from Jay Powell, he wouldn't want to trade places with other countries. So the United States is in a very good place, but you don't need a great economy for a stock market to perform well. What you need is positive surprise, some kind of catalyst. And what we likely have in terms of catalysts in both the UK and Europe is slightly improving growth picture, and of course, the potential for significant rate cuts this year, which we know we don't have in the U.S.
You mentioned Europe, UK. What about Japan, Kristina?
So I think there's certainly a lot of potential in Japan as well. What we're seeing is improved wage growth, an economy that is structurally improving after years and years of stagnation. So I think there's a lot of potential there. Japanese stocks valuations on a relative basis are a bit higher than Europe and UK, but still lower than the US. There's opportunity there, but keep in mind the Bank of Japan is actually hiking. Now that's a normalization. That should be a vote of confidence in terms of the economy, but it means to me that we're likely to see better performance from UK equities and European equities.
European equities in particular, of those that you've named, would seem to be at the highest risk of tariffs from the United States, as the U.S. is, as we are its biggest trading partner. So how do you think about that potential risk?
Oh, I think that's a significant risk, but we know that there's a risk in a lot of other markets that tariffs could impact them. And so I think we have to operate with that understanding, which is why at the end of the day, it's so important to be well diversified.
Kristina, good to see you. Thank you so much.
Thank you.